The Bank of Japan raised its benchmark interest rate to 0.75% in December 2025, the highest level since 1995, 30 years. The decision was unanimous. Inflation has exceeded 2% for 44 consecutive months, and the Japanese yen, following the announcement, weakened. The dollar rose to 157 yen. This is the paradox at the center of Japanese monetary policy in 2026, and it has direct consequences for every Asian tech investor. Welcome to Asia Tech Macro. I'm Alex.
And I'm Maya. Today we are doing the Bank of Japan episode. BOJ policy normalization, the yen carry trade unwind, what it means for Japanese tech exporters like Tokyo Electron and Fanuc, and what the IMF's call for 2 more hikes this year says about where Japan's monetary cycle is actually headed.
Let me lay out the timeline precisely. January 2025, BOJ raises rates to 0.5%, its first hike of the year. The second half of 2025 saw the BOJ hold amid uncertainty over U.S. tariff policy and Japan's domestic election cycle. October 2025, Governor Ueda states he is monitoring the 2026 Shunto spring wage negotiations before moving again. December 19, 2025, unanimous 25 basis point hike to 0.75%. The 3-decade high. January 23, 2026, BOJ holds at 0.75% in an 8-1 vote. The dissenter is board member Hajime Takata, who proposed hiking to 1%, arguing that upside risks to prices are increasing and that concerns over U.S. tariffs have since eased.
And just last week, February 18th, BOJ board member Kazuyuki Masu gave a speech saying that further rate hikes are necessary to complete policy normalization, explicitly noting that the policy divergence between Japan and other major economies is a key driver of yen weakness that is pushing up import costs. On February 26th, the IMF issued its formal assessment calling on Japan to continue raising rates, projecting 2 more hikes in 2026 and another in 2027, with the terminal rate expected to approach neutral by that timeline. The IMF specifically praised the BOJ's, quote, continued independence and credibility.
Now the numbers that matter for the yen trajectory. USD JPY ended 2025 at 156.63. ING's base case projects moderate appreciation toward 150 in the first half of 2026 as U.S.-Japan yield differentials narrow, driven by the Federal Reserve cutting toward 3.0 to 3.25%. The more aggressive scenario, if the yen weakens past 160, is 2 BOJ hikes this year, potentially the first as early as April or Q2, bringing the rate to 1%. State Street's head of Asia macro strategy has stated his base case is 1 hike in 2026, another in 2027, terminal rate 1.25%. EFG International puts the terminal rate range at 1.25 to 1.75%. The market is pricing in gradual but persistent tightening. The question is speed.
And here is why this matters so intensely for Japanese tech exporters. Japan's wage negotiations, Shunto, concluded in 2025 with the Japanese Trade Union Confederation, Rengo, securing wage increases of 5.25%, the highest in over 3 decades. For the 2026 cycle, major labor unions have set goals above 5% again. Rising wages mean rising domestic costs. A strengthening yen means overseas revenues translate back into fewer yen. For companies like Tokyo Electron, whose semiconductor equipment revenues are predominantly denominated in dollars and euros, a move from 157 to 145 USD JPY represents a meaningful earnings headwind that requires recalibration of analyst models. Let's get into segment 2. The export earnings pressure is real, but the picture is more nuanced than the headline suggests. Maya, let's unpack why not all Japanese tech companies face the same yen exposure. Right. Within the Nikkei 225, we are already seeing a documented divergence since December 2025. Oanda's analysis of the Nikkei 225 noted that since early December, the Nikkei 225 Domestic Exposure 50 Index has outperformed the Nikkei 225 Global Exposure 50 Index by approximately 5.4%. Companies with predominantly domestic Japanese revenue, banks, insurance, domestic consumer, are benefiting from higher rates and stronger domestic demand. Companies with heavy overseas exposure, auto exporters, heavy equipment, semiconductor toolmakers, face the dual headwind of yen appreciation and cost inflation.
But here is the important distinction for semiconductor equipment specifically. Tokyo Electron, Advantest, Disco, these companies' order books are driven by global semiconductor capital expenditure cycles, not by exchange rates in isolation. The AI infrastructure build-out, TSMC's Arizona expansion, Samsung's memory capacity additions, Intel's foundry recovery, these are multi-year, dollar-denominated capex commitments that don't get canceled because USD JPY moves from 157 to 148. What the yen move does is reduce the yen-denominated reported earnings from those commitments. That is a valuation adjustment story, not a demand destruction story. These are different investment implications.
The yen carry trade dimension is the global risk factor that goes beyond Japan's borders. Japan has functioned as the world's cheapest source of financing for over a decade. Institutional investors borrowed in yen at near zero rates and deployed those funds into higher-yielding assets: U.S. tech stocks, emerging market bonds, crypto. The August 2024 BOJ hike produced a preview. A sudden yen strengthening triggered a global equity sell-off as carry traders were forced to unwind positions to cover yen liabilities. Since then, the yen has remained soft at 155 to 158, which means the carry trade has largely been rebuilt. If the BOJ hikes again to 1% and the yen moves sharply toward 145, the unwind pressure returns. That is a global equity risk event, not just a Japan story.
And the political dimension adds complexity that markets are underpricing. Prime Minister Sanaya Takaichi won her election with a record $783 billion budget proposal and explicit fiscal stimulus commitments. Oxford Economics Nagai has warned that another BOJ rate hike could create friction with Takaichi if inflation declines smoothly below 2%.
Contrarian corner. And my position today challenges the market consensus that the BOJ's rate hike cycle is gradual, predictable, and well telegraphed. I think that framing is dangerously complacent, and August 2024 carry trade unwind already gave us the evidence we need to take the tail risk seriously.
Walk me through it.
The market consensus says BOJ hikes gradually, one per year. Terminal rate 1.25% by 2027. Yen appreciates moderately to 145. Japanese tech exporters take a manageable earnings hit. Everyone adjusts. That is the base case. Here is the problem with it. The base case assumes that the yen carry trade unwinds slowly and in an orderly fashion. But carry trades don't unwind slowly. They unwind when a threshold is crossed, and nobody knows in advance where that threshold is. In August 2024, the BOJ hiked by 25 basis points from 0.1 to 0.25%. The yen moved from approximately 155 to 142 in 3 weeks. Global equity markets dropped sharply. The VIX spiked to levels not seen since COVID, all from a 15 basis point hike in a country whose policy rate was still below 0.5%.
And the setup today is structurally similar.
More concentrated. In August 2024, the carry trade had been building for roughly 2 years at the post-COVID interest rate differential. It has now been rebuilding since August 2024 for 18 months at a differential that is still historically large. ING's FX analysis noted that the yen remains the most undervalued G10 currency by far. FX hedging costs have dropped from 6% annually in late 2023 to 3.22% now, which means it is cheaper again to run unhedged yen-funded positions. The carry trade is bigger now than it was before the August 2024 shock, and the next BOJ hike, whether it comes in Q2 or Q4 of 2026, is being telegraphed more clearly and more hawkishly than any previous move. One dissenting board member proposed 1% in January. The IMF is publicly calling for 2 hikes this year. When the market knows a hike is coming but doesn't know exactly when, the unwind risk is actually higher, not lower, because positions don't bleed out. They all close at months when uncertainty resolves.
So your view is that the tail risk is an August 2024 repeat, but larger.
My view is that the consensus has learned the wrong lesson from August 2024. The lesson the market took was the BOJ will back off if markets react badly. And indeed, the BOJ paused after August 2024. But the lesson that should have been taken is the carry trade is large enough to create a systemic unwind when yen moves rapidly. And the BOJ is now less likely to back off because inflation has been above target for 44 consecutive months and political opposition to rate hikes has softened. Takaichi herself has softened her anti-hike stance. The IMF is publicly supporting 2 hikes this year. The BOJ's institutional credibility is increasingly tied to continuing normalization. The next time the yen spikes sharply, the BOJ may not ride to the rescue. And if that happens when carry positions are at their current scale, the global equity sell-off will not be contained to 3 weeks.
And that has direct implications for Asian tech investing beyond Japan itself. U.S. tech stocks that have been partially funded by yen carry, NVIDIA, Microsoft, the AI infrastructure complex, face selling pressure in a disorderly unwind. For our listeners who are invested in Asian tech through U.S.-listed names, this is not an abstract Japanese monetary policy story. It is a direct portfolio risk.
Exactly. And here's the question I want to leave the audience with. The BOJ has now hiked 3 times. Inflation has been above target for 44 months. The IMF is supporting 2 more hikes this year. Wages are growing above 5% for 2 consecutive years. Every structural indicator says the normalization cycle is real and durable. Given all of that, why is the yen still at 155? And if the answer is because the carry trade is keeping it weak despite fundamentals, then what happens to global markets when the carry trade finally agrees with the fundamentals? Part 4. action items.
Number 1. Separate Japanese tech into yen-sensitive and yen-insensitive buckets and position accordingly. Semiconductor equipment makers, Tokyo Electron, Advantest, Disco, are yen-sensitive in their reported earnings but demand-insensitive to the yen. Their order books are driven by global AI capex cycles denominated in dollars. A move from 157 to 145 reduces their yen-reported earnings but does not reduce their backlog or their competitive position. That earnings reduction is a buying opportunity if you have conviction in the underlying demand. Japanese domestic financials, MUFG, SMFG, banks, benefit structurally from higher rates and a steeper yield curve. These two categories move in opposite directions in a BOJ hike scenario. Know which bucket you own.
Number 2, treat the next BOJ rate decision as a global macro event, not a Japan-specific story. ING's base case puts the next hike in October 2026, but explicitly notes it could accelerate to Q2 if the yen weakens past 155 toward 160. If you are running positions in U.S. tech names, emerging market fixed income, or any asset class that has historically been funded by yen carry, you need a hedge or a stop-loss framework that triggers before the yen moves sharply, not after. August 2024 showed that the adjustment from 155 to 142 happened in 3 weeks. That is not enough time to exit positions at reasonable prices if you wait for confirmation.
Number 3. Watch the 2026 Shunto spring wage outcome as the single most important leading indicator for BOJ timing. The BOJ has explicitly tied its rate decisions to wage growth momentum. Rengo secured 5.25% in 2025. Major unions have set targets above 5% for 2026. If the 2026 Shunto delivers above 5% again, expected to be confirmed in March and April, it removes the BOJ's last significant reason to delay the next hike beyond October. Shunto results will be public before the BOJ's May and June meetings. If wages clear 5%, the June meeting becomes live for a hike. If wages disappoint below 4%, October remains the base case. The Shunto outcome is the most predictable calendared trigger for the BOJ that exists. Watch it in March.
The takeaway. Japan's monetary normalization is real, it is structural, and it is being validated by 44 months of above-target inflation and 2 years of above 5% wage growth. The BOJ is not bluffing. The yen carry trade's continued persistence at 155 to 157 despite 3 hikes is the risk, not the comfort. When the carry trade agrees with the fundamentals, the adjustment will be fast. Japanese domestic financials are the clean beneficiary of normalization. Japanese tech equipment exporters are a valuation opportunity on yen weakness, not a structural short. And the global equity risk from a disorderly carry unwind is the underpriced tail risk in Asian tech investing this year.
The meta lesson. In monetary policy, gradual and predictable are not the same thing. The BOJ's intention is gradual. The carry trade's response may not be. Plan for the gap between those two speeds.
Next time on Asia Tech Macro, we are going to China. Specifically, the question that has been building all season. Is China's tech sector in a genuine recovery? Alibaba, Tencent, Baidu, post-DeepSeek? Or is the regulatory risk still the defining variable that overrides everything else? We have been watching the data, and it is time to give a definitive answer.
That is the episode I have been waiting to do all season. The data is actually quite surprising.
Stay data-driven. Bye.